All right, looks like we're live. Welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker NFLX, Netflix. Just give me a moment to double check a couple of settings for the stream, make sure everything's up and running. Okay. All right. So Netflix, in general, I think needs no real introduction. I did see after they reported earnings, a lot of their there was a little bit of a under enthusiastic reporting on future subscriber growth, and that caused them to come down pretty significantly, though not significantly relative to our previous valuation. We'll see what we come up with today. We're going to try not to spoil our thoughts about this one with what we have in the last one. I've looked at it as little as possible in getting the previous data off of it. This is the next company in the list of companies that we've discussed, or kind of our little forward schedule for streaming as far as which companies will, when they release their 10Ks, will be valuing, with the caveat that there may be one or two in between a few of these depending on when these 10Ks actually come out. But Netflix came out, so we'll be doing that one today, and we'll see which ones that come out the next after that for our stream on Friday. Nothing super major as far as economic data to report today. There may have been a couple things that came out over the weekend, but I actually haven't really looked into it, so I'm not really going to be talking about it today, even if that is the case. One thing I did kind of want to bring up before getting into this is some interesting sources of information. I've talked about them on streams before, that these are some major sources that I use, which is as well as Damodaran, who has his own YouTube channel that I highly recommend for people. He holds valuation classes at NYU that are finally back in person for the first time in a couple of years, though he was doing online classes for most of the time in between. Looks like my camera's a little bit low. But either way, this is what I generally recommend to people if they want to learn to do valuation the way I do. He doesn't use exactly the same methodology I use, but it's pretty damn close. I did learn a lot of it from watching his online courses, and these courses have just gotten started, these spring ones, so you can follow along with these classes as they go. And if you don't really want to wait that long, you can go to his playlists and look at one of the previous ones from previous years. But he also does data updates at the start of every year, which I highly recommend for people. He's done 3 of them so far. 2 of them had some typical usage of it. He just talks about differences in equity risk premiums, PE ratios, and stuff like that by country as well as by various industries, and just looking by asset classes as well, breaking down data into a pretty fine detail. And he has access to really fine detail that he pays for or has access through his university. So it's good to take a source of that, and his website is a huge source of data that I use myself. Especially this third update, however, it's mostly focused on interest rates and inflation, but a lot of people ask as to why I use a 10-year treasury as a proxy for economic growth, and that comes down to a theoretic principle that he describes in this video very well. So I highly recommend that for people who want to understand why a 10-year treasury or whatever you use for your risk-free rate. It's really just whatever your risk-free rate is. The risk-free rate itself is basically a defined, well-made market-based proxy for economic growth in the long run in the economy of which the cash flows of the company exist in the theoretic principle he describes in this video. So I highly recommend those videos and the series for people who are interested in those. So we'll get into Netflix now. As with a lot of my valuations, I have done a lot of the prep work ahead of time, so we can get into a few of those details. Netflix has $18.2 billion in debt at a weighted average maturity of 7 years and 4.5% interest rate. That includes their lease liabilities, though that's a pretty small percentage for them. Their geographic dispersion, you can see, is 43 to 44% of their revenues in the UCAN area, with 33% in the Europe, Middle East, and Africa area, another 12% in Latin, and 11% in Asia. We're using a mixture between entertainment and software entertainment groupings for their revenue segmentation, with an unlevered beta for the grouping of 1.38, so it's pretty high, but that comes generally with a not really high but not very small sales cap ratio of 0.88 and a pretty decent net margin of 14.58. Though Netflix does pretty good in both of those categories, at least in the most recent year, which we, as usual, have done those numbers already. So I will play their fourth quarter earnings call while I work on the rest of the numbers, or I guess I should say their fourth quarter earnings interview, because they do earnings interviews, not calls, which I always think is kind of funny. Seems like a good excuse to avoid taking a widespread of analyst questions, but whatever.
Hello, and welcome to the Netflix Q4 2021 earnings interview. I'm Spencer Wong, VP of IR and Corporate Development. Joining me today are co-CEO Reed Hastings, co-CEO and Chief Content Officer Ted Sarandos, COO and Chief Product Officer Greg Peters, and CFO Spence Newman. Our interviewer this quarter is Nidhi Gupta from Fidelity. As a reminder, we'll be making forward-looking statements, and actual results may vary. Nidhi, over to you now to kick off the Q&A.
Thank you, Spencer. Good to be with you all again. Great to see all the new content over the quarter. I've been a little less productive, so I think I can blame you all for that. As usual, I'd like to start with net ads during the quarter, which came in a little bit lighter than you expected. Just help us understand the underperformance there.
Nitty, 8.3 versus 8.5. I mean, that's
on 222 million. In fairness, Nitty said it was a little shy, so I'll take it, Nitty. So as I said, we delivered. First we're quite pleased with how the quarter played out. We delivered 8.3 million paid net ads, so it was just a bit shy, about 0.1% on roughly 222 million paying members. And overall, we're quite pleased with how our titles performed. We had big viewing. We started the quarter with Squid Game becoming a global phenomenon, and we ended the quarter in December with big TV series like the finale of La Casa de Papel, a big returning show in The Witcher, our two biggest movie releases of all time. So overall, the business was healthy. Retention was strong, churn was down, viewing was up. But on the margin, we didn't grow acquisition quite as fast as we would have liked to see. And on our large subscriber base, a small change in acquisition can have a pretty big flow through in paid net ads. And again, our acquisition was growing, just not growing quite as fast as we were perhaps hoping or forecasting.
Great. And as we look ahead to Q1, the guidance was a bit below kind of what was expected and what you've done in previous Q1s. Maybe just help us understand what some of the key considerations were that went into the guidance, and does it raise any concerns for you about anything structural, whether it's competition or saturation, or does it give you any pause in terms of sort of your return on content spend?
Sure. No structural change in the business that we see. What's reflected in the guidance, we guided to 2.5 million paid net ads in Q1. And what's reflected there is pretty much the same trends we saw in Q4. So healthy retention with churn down, healthy viewing and engagement with viewing up, and acquisition just growing, but a bit slower than pre-COVID levels. Just hasn't fully recovered. And we're trying to pinpoint what that is. It's tough to say exactly why our acquisition hasn't kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang that's still happening after 2 years of a global pandemic that we're still unfortunately not fully out of. Some macroeconomic strain in some parts of the world, like Latin America in particular. While we can't pinpoint it or point a straight line when we look at the data on a competitive impact, there may be some kind of more on the marginal kind of side of our growth, some impact from competition, but but which again, we just don't see it specifically. So overall, that's what's reflected in the guide. I'd say our big titles are also landing, at least our known big titles, a little bit later in the quarter with season 2 of Bridgerton in March, The Adam Project also in March. And I should note, we also, while we are taking, changing prices in countries every quarter, in Q1 of this year, it happens to be our largest country, as we announced last week, and actually our largest region with Canada as well. So that's probably a little bit more impact than a typical quarter.
But Nidhi, you're right to reflect on, 2 years ago we were 10 million above plan, which was a shock. Last year we were 10 million below, or 9 million. And so, the pull forward sort of, makes it hard to read. In the prior years we were very steady, so we could have confidence on incremental trends. But as Spence said, when we reflect, of course, hey, that's a low guide, and we think it'll be accurate. It's not sandbagged at all. Kind of what's going on, and there's a number of potential explanations in COVID, but then we worry about hanging too much on that. There's more competition than there's ever been, but we've had Hulu and Amazon for 14
It's definitely
years,
more than
so
COVID.
it doesn't feel like any qualitative change there. And overall, confidence in streaming becomes all of entertainment. Linear dissipates over the next 10 to 20 years. Very high confidence in that thesis because everyone's coming into streaming. So like market size, very large. Our execution, is steady and getting better. So for now, we're just like, staying calm and, trying to figure out, again, the COVID has introduced so much noise. It just wants us to give it some pause and as we work on everything we've always worked on.
And just to reiterate, I'd say, we took a big bet years ago on this, that people would move onto Netflix and Netflix type offerings to consume movies and film. That was a big bet that we've seen continue to go through. We have no change in our confidence in that. And I think what's really been great about 2021, even through all those conditions, we were able to kind of prove out two other theses that we've bet on starting years ago. One big one around our investment in international programming. Glad that we started that 7 years ago with Club de Cuervos. And now, we were betting that you could take films and series from anywhere in the world and entertain the entire world. And we were, getting bigger and bigger milestones against that goal. And now we have proven to have kind of global sensations from France with Lupin, from Spain with La Casa de Papel and Elite, and then in the biggest way possible in 2021 with Squid Game, which has become our biggest series ever, and it is unapologetically and perfectly Korean. So it's not built to be this kind of global thing. It's proving that great storytelling from anywhere in the world can entertain the world. And our other big bet was our investment in big budget feature films, and our bet that we could effectively release them and compete with big theatrical releases for audience and for attention. And Red Notice this year, of course, and Don't Look Up have become our number 1 and number 2 most watched movies ever on Netflix. And if you look at the hours that we publish out, you could do the math and back into it. They may be the most watched movies anywhere in the world this year. So I think those two bets coming true, it kind of strengthens our confidence in the overall bet in the service and pleasing customers and leaning into consumer first business models that we could succeed there.
Yeah, no, and I think that's part of the question, right? I mean, this was probably the best content quarter you've had. And looking at sort of flattish subs versus previous Q4s, obviously a great number, but it's kind of in line with what you've done the last few Q4s. What do you read from that? Is the customers sort of hurdle just higher in terms of the amount and quality of content that you need to deliver to get the same number of net ads?
Well, I think what as Spence was saying, we didn't see it in we didn't see it get a hit to our engagement. We didn't see a hit to retention, all those things that would classically lead you to looking at competition. But it's a stew of all of those things. Not only are we in a pandemic, we've kind of come in of and out of COVID at different levels in 2021, particularly the back half of 2021. So it's created a lot of a bumpiness, certainly, and not steady linear growth. which makes it a little tougher to predict. But all the fundamentals of the business are pretty solid.
Got it. You announced a U.S. price increase last week. Maybe just help us understand kind of over what time frame you think this will flow through, what kind of churn you might expect.
Yeah, I'd say you can anticipate it flowing through over the next quarter, the quarter that we're in right now, Q1, and we largely are seeing in the price changes that we've done most recently, and for the earliest indications that we have in the U.S., which we are it's still premature because we actually haven't actually rolled it out to any customers yet. What we've seen over the last couple of years, which is that sort of core theory that we have that if we've done a good job investing the members' subscription fees that they paid us into better stories, more great storytelling, bigger movies, more variety, then when we come back and ask them occasionally for a little bit more to keep that sort of cycle going, then they're generally willing to do that, and we don't see any significant disruption to the business otherwise in that regard. And I would say, generally, when we look at that sort of core theory, and we look at also the competitors, if you look at Disney Plus as an example, other streaming services out there as well, and their ability to grow, even as we've been growing as well, I think it's really strong endorsement for the core idea that consumers around the world are willing to pay for great entertainment, and it encourages us to continue that investment and to try and deliver more entertainment value and earn more of that share.
Yeah, no, it's a good point about your streaming competitors. And when I look at sort of your steady price increases in the U.S., it doesn't seem like you feel too constrained by where those competitors are priced. So is that a true statement? And I guess as long as your viewing share is sort of multiples of any other streaming service in the U.S., should we think about your price relative to cable actually as we sort of think about your runway? Not that you'll get there overnight, but as we think about your runway, is that really sort of the comparison we should be thinking about as opposed to other streaming services?
Big ask.
Yeah, we don't have an a priori sort of price target in any given country that we're tracking to. Mostly we're listening to our members and sort of iteratively doing this walk where the metrics that we see in terms of engagement and churn and acquisition and those kind of things are really our signal that we've done a good job at sort of creating this more value, and it's the right time to ask for a little bit more to keep that going. So to the previous comments around competition and things like that, we don't think that it's immediately replaceable or substitutable good, let's say, right? And so if we have incredible stories, movies that you can only see on Netflix, great TV shows, unscripted, now games coming, then that really, the value equation for any given, member or member to be in a market is just, are they getting good value for what they're paying? And as long as we do a good job there, we feel like we're fulfilling that need.
Good answer.
You also made a price change in India in the other direction. Maybe just help us understand what you're trying to achieve with that price change.
Yeah, I think it follows a whole set of activities that we've been doing in India over the years that we've been operating there and learning more about Indian consumers' tastes, et cetera. And that's broadening the offering in the service across many different dimensions. So it's obviously at the core is the content and the programming, and seeking to expand that and provide increased variety and range of programming that appeals and is attractive to more people in India. While we're thinking about go-to-market
that makes more sense.
And the partnerships that we have and making sure that we're available with those partners, at that place where, more people in India will find us, and it gets to payments and, many, many, many things. And when we looked at it and we saw sort of the sum total of all those activities, we felt it was the right time to decrease our prices there, to increase the accessibility to all of that sort of, those incremental, value or features that we've been trying to deliver to the market to more Indian consumers. And we also wanted to do it not just like we did with mobile, which is, a good lower entry price point, but do it across the range of plans that we had under the theory that some of those features, like the ability to watch on TV, with the basic plan, really unlocks more value in the service, and therefore would create, more retention, more attractiveness to those plan types for those Indian consumers. And again, we're doing this through the lens of what's the long-term sort of revenue maximization, our best guess at that exchange. And so in this case, we're basically anticipated that while we decrease ARM, average revenue per member, as a result of the price decreases, we're going to make it up in more subscriber ads. And I would say it's still very early in looking at India, and some of these effects like retention, it takes a couple months to get a very clean read on it. But the early data that we are seeing very much supports a positive read on that lens of revenue maximization through these changes.
And Nidhi, as you well know, but not all viewers might, what's unique about India's cable is about $3 per month per household. So radically different pricing than the rest of the world, which does impact consumer expectations.
Right. If this approach doesn't give you the desired result, and it sounds like it is so far, but if, fast forward 6 months or 12 months from now, it isn't giving you the desired result, would you consider sort of right-sizing your content spend in India, or, maybe consider an ad-supported model? I guess, in other words, how hard do you want to push for India? And are there examples of success you see either in the media industry or outside of it that give you the confidence that you can make money in this market long term?
It definitely has come down pretty far.
Time before we adjusted materially, because our experience in
I've always been pretty
Brazil,
pessimistic on
brutal for the first couple of years. We
Netflix,
thought we'd never break
perhaps
even.
unfairly.
Now we've got this great business.
But
and then Craig, why don't you talk about?
I value things the way I value it.
Yeah, I would use.
It's a company I would love to own.
My mind went back to that, and obviously it's a different country, different characteristics in terms of affluence and things like that. But it took us quite a while to unlock all of these components, product market fit, get the right content, all these different pieces. But then once you get that sort of flywheel spinning, it's been an incredible market for us and a source of tremendous growth in membership and revenue in the region. So I think we're quite bullish that India isn't fundamentally different in some way that we can't figure out how to tailor our service offering to be attractive to Indian consumers who love entertainment. We know that for sure, and so that I think gives us a lot of optimism to continue to work away at it.
I would just add. Sorry, go ahead, Reed.
The great news is in every single other major market, we've got the flywheel spinning. The thing that frustrates us is, why haven't we been as successful in India? But we're definitely leaning in there. Go ahead,
and there wasn't an easy one in the bunch.
Well, that's kind of what I was going to say. Like what Ted touched on, like for as much as we have what we believe is a terrific business and terrific business model that scales so well with content that can be created anywhere and travel everywhere, and you see that with our more than 222 basically million paying members around the world. It's also super hard. It's hard in every country, and every country's on a different adoption curve. And we talk about product market fit, but it's even though everyone loves film and TV and even games, it is very specific. Entertainment is still fundamentally pretty local around the world. So it's global and local, and we need to figure that out. So that is actually a good thing about our business, is that it scales well, but it's also super difficult. Otherwise, it'd be really easy for everybody to replicate
it seemed going into producing original content in India being almost impossible when we first started looking at it. And then this quarter alone, we've got original content coming out from Turkey. We're in production in Russia, from Argentina, from Mexico, from Sweden, from Denmark. So we've got original content coming from all corners of the world. We have 20 originals coming out of Korea this year. So the idea of they invested in this early and it built up on it, and that it really is going to be something that it's going to we think it will start flowering in India for all the same reasons: a good product market fit, content people love, value that fits with their life, and product they can't live without.
And I'll triple down on that point as well, Ted, because we're still learning even now as we have these incredible stories from all these different places around the world, how to bring them to that global audience in increasingly effective ways. And it's simple things, obviously, like subtitling and dubbing, and we've subtitled 7 million runtime minutes in 21 and dubbed 5 million.
All right, so we'll pause it there to do a look at the 5-year trend. Just looking at its multiple, I mean, expensive as all hell, but as you can see, it's definitely just gotten cheaper and cheaper over time. So over just the 5-year period, it's absolutely at its cheapest point right now. So that's definitely one thing it's got going for it, though obviously a 38.5 normal PE and 31.5 with R&D adjusted PE is still pretty expensive, but it's way better than any other point in history for the last 5 years anyway. Then looking at the sales to capital ratio, well, you can see that it's come down over this period, but in this same period, if you were paying close attention at the line items in the cash flow statement, we were just starting to reach the period where they were still doing DVD stuff. So this is kind of the point where their business model made the full switch over, essentially. It began much earlier than that. So, but either way, the point is the sales to capital ratio coming down can be seen as an effect of them switching more to streaming over the DVD option, because DVDs are relatively cheap. And while streaming is not expensive in a physical sense, it is expensive in a production sense, which will skip right past the balance sheet. I'll go straight to the cash flow statement just to talk about that, which, if you may have noticed, the line items that I was including in the change in working effect on cash flow is inclusive of these wrong page is inclusive of these what is it, additions to streaming content assets and changes in the streaming content liabilities. So they have these content assets and liabilities, both of which are produced content and content licensing that they've purchased, which is sort of like intangible asset purchases and amortization, but not quite. I'm not including it in the depreciation and amortization because it's a little bit fuzzy for that, but I do want to stick it in this line right here because this is still part of that capital expenditure part. So it'll really make sure that the way we think about the capital expenditure on an adjusted net sense, which is inclusive of all forms of capex and all of the forms of depreciation and amortization against it, then you actually get the full idea of what their true capital spending is per year relative to their earnings, and it's very large. And so that's basically what that is them switching to producing a large amount of content. However, that is one of the things they were just mentioning in their call, is that they have that their model is not that replicable because it requires a large amount of work, and so that is the true. One of the things I've always been kind of negative on Netflix on the whole in the past about is the fact that content, the ability to produce all that content, I was kind of doubtful of, but it does seem like they're having a much more success than I thought. So anyway, as I've discussed before with the R&D capitalization method, it does take time for the amortization to work its way through the spreadsheet. So by the time we make it through 5 years here, we really only have 1 year that's actually accurate on the corrected net income. So with the corrected net income in 2021, we can see it's about 21%. It may come out actually slightly smaller than that, but either way, around 20 to 21% is essentially the corrected net income margin when they adjust for R&D. And so that, on the back of a sales to capital ratio just below 1, is a pretty good balance as far as qualitative factors go. So it shows that Netflix is in a pretty good high quality position as far as their industry, and in their industry, we had actually discussed that they the expectation is relatively low sales to capital ratio and a little bit lower sales net margin. So they're high on both of those categories. So anyway, moving back up to the balance sheet, we can see that their situation as far as their assets have grown pretty dramatically over the 5-year period, more than doubled, while their liabilities have not quite doubled. So they have actually overall improved the equity position of their company pretty dramatically, and that's actually, you can see, more than 5x, which was one good reason why you could argue that they've had such dramatic growth in their stock price, is that their book value is definitely starting to line up, even if it does feel like their sales and their earnings are dramatically lagging. Although, as we said, their earnings are starting to catch up. So even though their sales is still pretty low relative to their market cap. But so some of the valuation metrics with basic multiples is starting to come into line, while other ones are not necessarily. So anyway, I think that's all we really need to cover here, other than just obviously the pointing out that they have such significant growth in every single year. So really just being able to predict the slowing rate of that growth is really the factor that's going to come down to how accurate this valuation goes. Anyway, I'll continue the call now.
Million runtime minutes, but at that scale, we're learning actually how to do that better and how to make that localization more compelling to our members. But it also gets to even like things that you wouldn't even anticipate, like just how you present these titles in an emotionally evocative way. And we describe a story maybe as nostalgic or eerie, and that means something to us, but you can't just literally translate that. You have to find out in every culture and language around the world, what is that similarly emotionally evocative descriptor that is going to communicate really easily and quickly what a story means. So there's so much work and incredibly fascinating things that we're learning about how to do that every day.
And in many of those places where we built that out, there was zero infrastructure for subtitling and dubbing.
Well, speaking of content that travels well, South Korea, as you mentioned, Ted, has been a really bright spot for you. Yeah. And as you said, you're launching over 20 new shows there this year. What are sort of the unique factors that drove your success in South Korea? And more importantly, what do you think the adoption curve can look like here relative to maybe what you've seen in other markets?
I'd say first and foremost, we've developed over the years an incredible team in Korea and South Korea that has worked with the talent community, that recognized the storytelling that really works in Korea, that didn't try to make it different so it would travel, but really tried to find all the things about Korean cinema and Korean drama and build them up in a way that people could see kind of new levels of production value. But it's not like we had to go in and teach anyone in South Korea how to make great content. It's an incredible market for that. And there's always been curiosity around the world. The K-drama market has always had little pockets of success all over the place. But I think the ease of delivery that we've offered has kind of pushed that into the mainstream. Yes, there was this kind of a turning point with Parasite and Bong Joon-ho's Oscar last year to kind of open up people's minds to it. But we saw that even way before that with Okja, working with director Bong, that there was this incredible storytelling culture that we could tap into, and that people would love K-dramas and watch them all over the world. It just wasn't that easy to find them. And at Netflix, we've been able to kind of put together the great storytelling and great delivery and a great value proposition that has grown the watching of Korean content in the U.S. to numbers I would have never believed 3 years ago. So 100% growth in 2021 over 2020.
Will we get a second season of Squid Game?
Absolutely. The Squid Game universe has just begun.
Great. Looking forward to that. Shifting gears to Latin America, this region feels like it's maturing at a lower level of penetration than you've seen in the US. Is that due to competition, affordability, account sharing, or something else? Or maybe you disagree with the statement that it's actually maturing, but help us understand if there's anything you can do differently to sort of drive penetration levels there higher.
Well, first, I just wouldn't necessarily read through that it's maturing faster, Nidhi. I mean, again, I just don't want to understate the impact of what we've been going through for the last 2 years, and then Latin America, in particular, has been more strained. It's had less, kind of government funding and subsidization relative to many parts of the world to kind of fuel their economy. On top of that, we also continue to increase prices in that market last year across some big countries for us: Mexico, Brazil, Argentina. So between macroeconomic factors and general strain, the business is still growing there. We grew by about 2.5 million members last year, so under the kind of pre-COVID growth rates, but still growing. And it is a market where pay TV is healthy. Folks love film and TV, and so I think there's a long runway of growth there. It's also been a great market for us for Spanish language content that we're creating for the rest of the world. So we don't see, and others can chime in, need to change strategy. We continue like we talked about with India. We're getting better everywhere every year. We're getting better with our local content in Brazil and Mexico and so forth. So there's a lot more to come, but it's not a fundamental change in strategy.
Agreed.
That makes sense. Maybe just stepping back, you've talked about 800 to 900 million homes globally outside of China. That's sort of your TAM. You're, call it 25% penetrated into that. as you're seeing how various markets are playing out in terms of penetration levels, some higher, some lower, obviously they're all still growing. Has your thought process changed at all on, how many of these 800 to 900 million homes you can have ultimately, or, sort of the time frame to get there, whether it's higher than you expected or lower than you expected? And how might you actually evolve your content strategy or your pricing strategy to get the next 200 million subscribers?
Yeah, I'd say, Nidhi, we on that pay TV comparison, we look at it. We're in the U.S., at about 2/3 of the pay TV high water mark. And so, the back third is definitely going to be harder than the first 2/3 in terms of appealing, more unscripted, more superhero, and we're working on all of that. Because we don't have sports and news, you might say, well, if we get to 80% or something of pay TV, that's a good accomplishment. But also, streaming TV is such a better experience than the old linear TV. In some ways, we think to ourselves, we should be
True.
higher than pay TV. A combination
I don't know
of
about
better
that.
pricing and better experience. So,
ATV was
certainly,
overpriced due to
frustrating
artificial
for us,
monopolies.
the current slower growth. It's why, it could well be kind of just COVID effects, or it could be as you're, pushing on smaller market than we thought, but I'm not sure why. So, we try to be really rigorous of, thinking about the long term. It's possible that we'll get there, but slower than we thought, smart TV adoption, complexity, those kinds of things. But, we're still focused on the original thesis of, if we become incredibly compelling, everyone's going to want to be, a Netflix member.
Mm-hmm.
And I know it feels like we've been saying it for a long time, but it's early days. It
Mm-hmm.
really is. And I think about the evolving value proposition and how it's still maturing. The idea that, big ticket movies that people really care about premiering and being part of your Netflix subscription is actually taking the value proposition to a new level than it was just a couple of years ago. So I do think, like I said, it's a dynamic market for sure. It may not be as be as steady as people can think about it in terms of we're going to add X number every month, every quarter, every week. But there's no question that that's the direction the business is going in.
Yeah, yeah. And Ted, that's a good segue to where I wanted to go next. You had an incredible lineup of films in Q4 with a lot of viewing. I'm curious, what did having a strong film slate in the quarter do for you relative to periods where you didn't have that? Did you see more aggregate engagement, lower churn, more conversation? Just, what is sort of unique about delighting your customers with a film versus a show in terms of kind of the benefits that you see?
Yeah, there's a big theory, which is that people differently value movies because they always have to pay for it. You have to buy a movie ticket, you have to buy a pay-per-view transaction or a DVD. There's always a kind of a transactional and a pretty big one for some people to see a big movie premiere in your home. And so there was this kind of temporary effect that some other folks were doing, but it's in our permanent model to premiere our big movies on the service. And I think people, even if you really watch mostly television, you have a movie night, and we can service you on movie night. I think that's a very big, important value proposition that we have that's different from everybody else. And that these are the movies that people really love and care about. And you start seeing them at the scale of Don't Look Up and Red Notice in Q4, and it gets you just super excited as to be what could be next when, what's coming next. And for that, we have things like The Adam Project coming up with Ryan Reynolds and Sean Levy directed, coming up in Q1. It's a phenomenal movie for the whole family. With big action movie from the Russo brothers like Gray Man with Ryan Gosling, Knives Out 2, Enola Holmes 2. So with this movie lineup that any one
Russo
studio would
brothers
kill
and
for,
Ryan Gosling.
any one season. We've got new
That
movies
sounds
every
cool.
week on Netflix, and they're big movies that people care about. And we think once that expectation is set and we keep delivering on it, people will react to that too.
Great.
And Nidhi, I just add that at the core, what our members love and what they tell us they love is a great variety of high quality content, and that means across TV, film, and hopefully games over time in a much broader way. So films, having a great film offering is for us a key part of that equation, and so I think we're just starting to fulfill more and more of that, our member kind of needs and wants and satisfaction. That's what we're seeing, but it's not like it's just so differential than something else. It's part of that overall quality and variety of entertainment offering.
I also think it differentially serves people watching together. It's much easier to watch a movie together than to make sure you're all tracking on the same episode every week all over if you travel or whatever you do. So that kind of together experience we can deliver on every weekend on Netflix is pretty great. And I think about even just in the upcoming quarter alone, Spence talked about variety. Everyone has very different tastes. So any one movie is only going to serve a segment of the audience. Now you get big, exciting thing like Don't Look Up and Red Notice, you can get to a big chunk of the base, but you're still only getting to about 60%. So to do that, to serve everyone, you have to have a big variety of output. So it does seem like a lot of volume, but it's not all for you. So in Q1 alone, we have the Adam Project I mentioned. We have Munich from Germany, Texas Chainsaw Massacre, which is kind of a reinvention of that franchise. Tall Girl 2, which is a sequel to one of our big YA rom-coms. Home Team with Kevin James. Judd Apatow's new movie, The Bubble. That's all in Q1. And plus, original local language films from all over the world as well. So to meet the kind of variety of taste, we're able to really step up and deliver no matter what that taste is.
Yeah, that makes sense. Reed, you talked in the Q3 call about sort of, over time building out the whole experience of games, consumer products, live events, et cetera, around some of your IP. And it obviously starts with great IP and great storytelling, but what else do you have to get right operationally and strategically to really build a franchise? And do you feel like you have the pieces in place now?
We're building those muscles steadily with our consumer products, both like the Squid Game tracksuits, and then we're making a big push on experiences that are mobile and portable, and we can set them up quickly, and developing that muscle. Obviously, the gaming muscle we're very young on and building. So if you think of a world in a few years where those are strong muscles, and then you think of the next Bridgerton or Squid Game coming through, that's when we hope to be able to really pull those pieces together. And people talk about franchise like it's 0 or 1, but of course there's a complete continuum that will add value in the short term, to our various titles, and we're doing that already through the consumer products world and having people feel a bigger connection to those big franchises. So it's already working, but it's probably, 20% of what it will be in a couple of years in terms of the auxiliary boost beyond just the title.
Yeah, and I'd say on that continuum, Reed, you've got Stranger Things, which I'd say is as valuable a franchise as exists today in entertainment around the world. We certainly have things that are in their early stages of becoming a franchise, like Bridgerton, which we launched our second season of this, our second most popular show ever, in
Very
Q1.
good things.
And we're also, this year, you'll see an origin story on Queen Charlotte and this incredible Bridgerton live experiences around the country and around the world that fans will flock to and flood their social media feeds with. And there's consumer products that go along with that as well. So it's all those kind of makings of a franchise. Instead of trying to tapping into one that's been building for 50 years, can you build it from whole cloth? And I think Stranger Things is a proof point that you can.
Mm-hmm. We touched on gaming a little bit. It's very exciting to see some worldwide launches during the quarter. Greg, I know it's early days, but what has sort of the reception and engagement been from the subscriber base, and what have your learnings been as well?
Yeah, as you say, it's tremendously exciting to get to this point because we basically have been building the plumbing and all the technical infrastructure just to get to the point where we can do this, which is consistently launch games globally, to all of our members. And it's great to do that. And now, as you point out, we're now really getting to learn from all those games. What are the discovery patterns? What are the engagement patterns? How are they performing? What do our members want from games on the service? And it's still very early days, but generally what we're seeing is, not surprisingly, we have a growing number of monthly active users, daily active users on these games. And so we're generally seeing good growth in that regard. But really, as we're doing this, we've been building in parallel what I'm super excited about it, which is this sort of internal development capacity, our own game studio. We've been hiring some incredible talent that brings a set of experience to this process. We've done an acquisition in this space, and that now allows us to incrementally, gradually over a period of time get to that sort of the value that you and Reed were talking about, where we get to deliver now interactive experiences that are tied to the IP that we're excited about, that are timed with it. And that, I think, is really when you're going to see a next level of unlock around the value we can deliver to members.
Given that gamers tend to sort of consolidate their time around a smaller number of titles compared to video, where we tend to consume a wider variety of content, would it be more efficient to sort of buy your way into some well-known titles to sort of anchor the product? Just the last couple of weeks, we've obviously seen a couple of major companies make big acquisitions, or at least announce big acquisitions, because this is obviously something that's difficult to build organically. I'm just curious what your reaction to that is, and why isn't Netflix participating in big acquisitions given your aspirations in gaming?
Well, it was exciting to see the activity in the space, and I think to some degree it's an endorsement of the core thesis that we have around subscription being a great model to connect consumers around the world with games and game experiences. And we're open to licensing, accessing large game IP that people will recognize, and I think you'll see some of that happen over the year to come. But we also see, back to Ted's building out a whole cloth, and the ability to sort of take the franchises or the big titles, let's call it, that we are excited about, and actually develop interactive experiences that are connected to those. We see a huge, long-term, multi-year opportunity in that too. So, we're very open. We're going to be experimental and try a bunch of things, but I would say the eyes that we have on the long-term prize really center more around our ability to create properties that are connected to the universes, the characters, the stories that we're building in other places, and sort of magnify that value for the fans of those stories.
Hey, Nidhi, we have time for 2 more questions.
Okay. Maybe Reed, just a bigger picture question for you, and Spencer, I might have more than a couple questions. But you have this global subscription product that's inside sort of hundreds of millions of households around the world, and you really nailed 2D lean back content. But there's this whole world of interactive or semi-interactive content, whether it's gaming or fitness or education, and at the more extreme end there's VR content, and now everyone's talking about the metaverse. You've obviously already gotten going on gaming, but as you look at sort of this broad spectrum of content, how much of it do you want to sort of wrap your subscription around, thinking about the long term?
When you say how much do you want to, that would be a high number, but we have to be differentially great at it. There's no point of just being in it. That's very dilutive of the whole proposition. And so it took us several years to get great at English original series, and you saw in the letter on the Google search trends how well we did there. We built with a lot of effort, a really strong film franchise, and that's Ted calls it just the third inning. It's like we're really just getting going to what we think we're going to be able to do there. Of course, we've got all the international content. We've got unscripted documentaries, and then gaming, which initially we're focused on the mobile gaming, is a big one. So I would say when mobile gaming is world leading and we're some of the best producers, and like where we are in film today, 2 of the top 10 for our gaming, then you should ask, okay, what's next? Because we're definitely crawl, walk, run, and let's nail the thing, and not just be in it for the sake of being in it or for a press release, but we got to please our members by having the absolute best in the category. And Ted and Greg have been doing a terrific job on that. We'll just continue to work on it. So cue it up for that when we're winning in games, then we'll take the question.
Great. Spence, just turning over to you on margins. Does the guidance for a lower level of margin, and you gave a lot of explanation around that in the letter, but outside of sort of the FX impact, does it have more to do with some of these incremental investments we're talking about, like games and perhaps consumer products, or does it have more to do with sort of the lower level of revenue growth that you're expecting?
No, it's really just FX, Nidhi. So as we said in the letter, we lost about $1 billion of expected revenue in 22 through FX. That's about 2 points of margin. So if you just kind of look at our guide and add that back on, we're right on our pace of adding about 3 points of margin per year. And can't forget, we were over delivering on margin the last couple of years. So
if I add that back on,
that's really all that's happening here. And the FX move happened in really the last 6 months of last year. So what we've always said is we don't want to swing the business unnecessarily fast. We want to be able to invest in a healthy way into our growth opportunities. So, and over time, we will then right size appropriately our investment levels, our cost structure, our pricing in order to right size for where the currencies are coming in. And so this gives us some time to do it. So it gives us a little time. We will catch back up. We're still committed to roughly average of 3 points of margin increase over any few year period. But there's no change there. We've been factoring in our content investment, our games investment all along. And I just want to say on our growth too, we talk a lot about this deceleration. Obviously, we'd like to grow faster, but there's still very healthy growth in this business. What you're seeing in, we ended the year last year with 19% growth.
All right, I'm going to cut it there so we can do our 10-year trend, getting into everything. I like the way his voice kind of squeaked when he said, still high revenue growth. We're still going to grow really fast. Don't worry, guys. I mean, whatever. Might have just been a squeak, but a little funny. Anyway, so looking at the sales to capital ratio, you can see that the trend I was talking about before is even more pronounced now that we look at a 10-year trend. They were in pretty high levels of sales to capital ratio, and now it's starting to push down towards like software, hardware development level of stuff, like something we were looking at with Intel type level of sales to capital ratio, which is pretty interesting to see. So all that content is very expensive, and it is making a huge dent on their overall capital base in that terms. And then as we were talking about before, that they're trading cheaper than they had over the 5-year period. They're no longer the cheapest. It looks like 2014 was when they were actually at the cheapest. But overall, it's still pretty good. It's as cheap as they've ever been since 2015. So that's pretty awesome. Looking a little bit further up, there is a couple things that I did miss when we were talking for. I'll get to that when we get to the cash flow statement. But looking further at the balance sheet, you can see that the progress we were talking about on their equity is even more pronounced now. They went from $745 or so million in equity in 2012 to now almost $16 billion in 2021. So that's pretty awesome as far as overall book value growth goes. Their liabilities have grown pretty dramatically, but their assets have just grown way more dramatically as a result. They do have about $6 billion in cash relative to their what is it? I think it was like 16 or 18 billion dollars if you include current and long-term and lease liabilities. So a pretty decent amount of cash relative to their debt now. They're no longer really a debt-threatened company like they were a few years back. One thing, so this is the thing I missed before when I was talking about the 5-year trend, is I forgot to point out that the returns on invested capital have been improving over that entire period, which is pretty awesome to see. Usually we see those returns starting to diminish for a period of time. Looking back over 10-year periods, a little bit more of a ebb and flow. As you can see, it was kind of up at higher levels here. So that it looks like during the business transformation period, they had a large decrease in returns on invested capital, but now that those returns on invested capital are starting to show up again, which is also as good of an indicator alongside the PE ratio. I mean, like, if I was to look at the PE ratio and returns on invested capital as just like two measures and nothing else, then those two trends together, seeing that the PE is now getting cheaper than it's been over a 6-year period, and that the returns on invested capital are now at a higher point than they've ever been in a 6-year period, that alone is a pretty good signal on the face of it. So looking at the the actual cash flow, the one thing I also didn't really cover during the 5-year period trend is looking at these sums of things. The overall free cash flow that they earned during the 5-year period was 2.2 billion, relative to the total common payout that they didn't really have at all. It's actually a negative almost 100 million. So they were still essentially requiring equity from their investors, and even though they could have theoretically paid them about 2.2 billion, though 2.2 billion is obviously pretty measly relative to, if we think about like what their average market cap during this period was. The average market cap based off just those 5 numbers was 170 billion. So 2 billion in payback over 170, as you can see, it's like less than 1% that they theoretically could have been paid back over the entire time frame, which is pretty sad. Again, that's just a rough numbering, so we're using an average like that. But if we look at the entire time frame of the 10-year period, you can see the entire sum of cash flow that belonged to them was actually only about 3 billion. So it's pretty interesting. $2 billion in equity cash flow showed up in the last 5 years versus 3 billion in the 10-year period. So that means in this period there was about 1 billion, and it's about 2 billion here. So they did double their overall cash flow growth. Though over the entire period, the total common payout accelerates actually to a total of 400 million. So still requiring equity investing over that entire time frame. Looking at the adjusted net capex, the overall capital expenditure number that we were talking about over the entire time frame, you can see that it is just growing and growing and growing dramatically. So it does show that they've been making these capital investments larger and larger, which is partially why it shows up on the sales to capital ratio declining so dramatically over the period. But again, that is shown up in the income statement pretty solidly as well. Their reported net income has gone from measly single digits up to solid double-digit numbers, getting close to 20%, 17% in the most recent 2021. If we use our adjusted net margin that we use after R&D, then we actually end up with about 20.5% in 2021 versus well, again, you only get really 5 to 6 years of accurate numbers, so it was still in single digits in 2017, 2016 figures. These numbers don't have the full amortization effect on them, however. So that is still a pretty strong growth in net margin, which is parallel with the returns on invested capital. So it's all really good on the fundamental basis. And then voila, look at that. Solid double-digit revenue growth in every single year. 26.5% CAGR growing to 29%. It's only really started to slow down literally in this most recent year. So it's a whole lot of talk of slowdown for not that much slowing down, to be honest. But it is something that has to be kept in mind. Again, as we've talked about, their interest rate situation has improved rather dramatically. This interest rate is pretty well aligned with the number that we have on the book, so that's pretty good. I guess we can come over. No, don't pay close attention to this. We still have to do a whole lot of things on it. That's basically assuming no real growth on them. We will go ahead and throw some growth in here, just so that when we're looking at these numbers, it's not going to be stupid, but we will come back to that. That's just kind of a placeholder situation. And we'll go ahead and kind of do the same thing over here. So these are at least in the right ballpark area, but we will start at the bottom with the debt to equity ratio and the cost of equity. So the levered beta after adjusting for debt, we come up to 1.49 for the beta we're going to use. They have a debt to equity ratio currently of about 9%, so pretty small amount of debt, but it is a large beta to begin with. That gets us to a total cost of equity of 10.15% relative to the weighted average cost of capital of 7%, which is pretty great. And again, the weighted average cost of capital against returns on invested capital north of 22%. Over the 3-year period, we have 18.625%. I'll use the 3-year period. I feel pretty satisfied with that. And I feel pretty satisfied using the 3-year period for the sales to capital ratio as a basis as well. Now, as far as debt expectations for the future, if we're looking at their market cap of around 200 billion right now, and we assume that perhaps there's a dramatic collapse in the market cap of maybe even like 33 to 50% or so, well, we'll go kind of with 33%. So you can see it getting under like maybe 130 billion, and then comparing that to the amount of debt that they actually have. If we assume that they take on a pretty significant amount of debt, maybe doubling it to 36 billion, that would put them really in the worst case scenario at like 30% of a debt to equity ratio. That's like the worst case scenario, pretty much. So pretty low. And then in the best case scenario, yeah, 0 is pretty much going to have to be the floor of it, considering their situation as far as the current debt amount to go. Now, obviously, you might be like, oh wow, we dropped it from 100% to 30%, so that less debt suddenly took their value away pretty dramatically. Well, that's because capital investments are expensive. So if you use debt to finance them, that can actually help the equity situation. Now, as far as debt to equity for the analyst goes, we'll maybe just throw 10% in there as sort of a baseline number. We'll see where the probabilities leave us at for that. That puts it at 14%, which is probably too high. We can probably drop this to 25 and maybe drop this to 5. And let's see, that puts our distributed value at 11%. I suppose we can put it a little bit lower. I'm going to assume that they're going to keep a pretty low debt to equity ratio, 9.25%. I guess that's fine enough for now. We have to leave at least solid room for it to go up in the worst case scenario. Now looking at sales to capital ratio, they're, like I said, sitting around a 1 for the 3-year period. I'm going to assume that they can stay in that range, although it does show that they're dropping over time. It's perhaps safer to assume that they go to their industrial grouping. Actually, you know what? Let's go ahead and just do that. That's seems like a smarter way to approach this. I assume that the analysts are more optimistic on that, and then we'll have this drop down there towards 0.88. So boom, we got that in there, although we'll adjust it for probability, so it'll shift things around a little bit more. Let's go up the line. Curious to see what, yeah, that situation is looking pretty good. Let's see, our current projected return on invested capital is around 20%, so the current projections are not insane, but there's still lots of adjustments we can probably do to them. Now looking at the net margin, we currently have an expected value of 16%, which is probably way too low. Probably for the analyst number, I'm going to assume that it stays in the 20% range, around where it's currently at, and then we're probably going to readjust this to make the midpoint closer to 20%. Yeah, so leaving that kind of in line, it's pretty much in line with the default things I like to typically do, which is make the worst case scenario maybe 50% of where it currently is, and the best case scenario maybe 50% higher. I don't feel any real needs to deviate from that majorly right now. Again, we'll adjust things for probabilities a little bit, but that leaves things kind of where they currently are, essentially, on most of those expectations. That brings the returns of invested capital to 24.61. The returns of invested capital have been climbing, so the idea that they're going to climb for Netflix feels pretty reasonable to assume in the near future. And going back up to the revenues, I don't necessarily feel super strongly about leaving 25% on the revenue growth, but at the same time, I also think 0% for a worst case scenario is way too extreme. Just being honest, it's like they're not going to grow at 0%. There's like no way in hell, even if like the rest of the world stopped giving them growth, like even if there was no global growth for subscribers whatsoever for them, they would still eke out some American growth. I think like it's just unlikely. I'll maybe put 5% in as a worst case scenario, but that does mean I probably need to bring down the top level much more dramatically to be able to bring the overall number down. Bringing it to 22-23% I feel perhaps fine about. Now again, this is a COGR, so that means over the entire period it has to come up to this number. So it might be in these next 2 years they do closer to 30%, but I'm assuming that they're probably going to have sub 20 for the last 2 or something like that. Now we can maybe eke it out a little bit higher than it's currently set right now. Again, we can maybe just do that with probabilities. Because I would feel maybe 23, 24, maybe a little bit higher than where it's currently at, but nothing too much higher. Let's see, adjust a few more things. Again, the interest rate, I think that's actually pretty much in line with the book, so no real need to adjust that. Let's take a look at the corrected tax rate. The current corrected tax rate on a rolling basis is an averaging 6 to 7%, so we do need to give that a little bit more of a push. We'll just go ahead and double it, because that's going to adjust their terminal tax rate primarily, which is actually give them a slight benefit, but it's not really going to adjust their overall value too much. Let's see. Oh, okay. For the corrected net margin, we won't actually use the 3-year average as our basin. We'll go ahead and actually just use the most recent year, because obviously they've been on a pretty strong growth trajectory, so I don't feel the need to assume that actually has to breach upward on that. Give them a little bit of a slight benefit of the doubt. Okay, I'm not sure there's too much else that needs adjusting other than the default risk. I think like maybe I'll give them a slight, oh, I mean, I was still gonna do the probability adjustments, but okay, so let's adjust the probability. Top favorite, take 10 out of there, shove it in the middle. It's always a classic move for me, I suppose. That brings the expected revenue CAGR to 23 to 24. That's in line with what we wanted. This brings up the expected net margin in line with most recent years, so we're just assuming they keep the same net margin. That brings returns on invested capital 25%. That's a little high, but nothing too crazy from the current level. That brings the sales to capital ratio on an expected basis to 0.9. So we're assuming that they at least push a little bit higher than their industrial grouping. And then that brings the expected debt to equity ratio to 8.75%, which really just assumes they stay in the same range / increase their market cap ever so slightly relative to debt. So, okay, the only thing left to do is to adjust for the default risk, which we will go ahead and do. Let me pull open that sheet. Taking a look at the terminal expectations of debt, we can see in the best case scenarios and in the analyst scenarios, they have debt pretty close relative to the amount of cash they currently have, which means in these scenarios, I'll actually assume that they completely can pay off the debt in all cases, though the percentages were going to be really, really great for these numbers anyway. We'll go ahead and use 0 for that one as well. Yeah, because those are all really high interest coverage ratios, so that basically assumes easy payoff interest coverage on that one. Okay, so this will bring it down to 0.69, and then this one I'll leave it 0.85. So super low chance of default now, which is good considering like literally only 2 or 3 years ago they had a really high chance of default. So it's a huge improvement for Netflix. However, obviously their valuation is still just up in the clouds regardless. Okay, I don't think there's anything else that needs adjusting. It's all coming through. Okay, so the analyst's expectation for EPS growth is 25%. What did I get as an implied number for the analyst out of curiosity? Oh, incidentally, I got 24% as the analyst number. That's pretty interesting. I had totally incidental on that. And there's probably not really going to be too much share buyback. Well, maybe there will be. So maybe this is a little high actually. But either way, look at the value. So let's call it there. Okay, so that's going to do it for Netflix. Ticker NFLX. The U.S. Treasury today is selling at 1.778%. Mature market equity risk premium that I have is 4.96%, which gets me to a discount rate for Netflix of 10.10%. They do not have a dividend at all. 5 years ago, they had sales of $8.8 billion, and this is against sales in the most recent year of $29.6 billion, which is 27.5% or so growth in sales each year for the last 5 years. The sales to capital ratio for the last 3 years on average has been around 1, compared to an industrial grouping of 0.88. They have returns on invested capital for the last 3 years on average around 18.62%, and they have a debt to equity ratio currently of 9.02%. The default risk in the most recent year was less than 1%, pretty negligible, and their R&D adjusted profit margins in the most recent year was 20.51%, which is relative to industrial grouping of 14.58%. So their overall sales to capital ratio and profit margins are both higher than their industrial groupings, which gives us a sign of a pretty high quality business. The profit that they've had in the most recent year was about $6 billion. This is profit adjusted for R&D, and they're currently selling for $427.14. Now, our probability distribution is somewhat tilted towards optimistic end of things. We took a decent amount of percentage from the second model and pushed it into our median case middle model. And that gives us revenue expectations of $37.9 billion in the worst case scenario, or to possibly $159.7 billion in the best case scenario, with an expected value of about $89.1 billion. That gives us growth expectations of anywhere from 5% in the worst case scenario to 40% growth in the best case scenario, which gets us 23.75% in an expected value. Our expected sales to capital ratio is 0.9, with a return on invested capital expectation of about 25%. We also have debt to equity projection for the company of about 8.75%, and default risk during the period we project to be as close to zero as it can basically get. Profit margins adjusted for R&D, again, on an expected basis, we have 20.5%, but really it's a distribution between 10% and 30%, which gets us profit expectation distribution of anywhere from 3.7 billion to possibly 47 to 48 billion, with an expected value of 19.3 billion. That gets us a expected present value of $293.94 after using the discount rate that we have come up with, which we also have 5-year forward value targets for, which are unadjusted for any dividends that we paid out during the period, and to a worst case scenario of $153.48, all the way to a best case scenario of $1,149.43, with an expected value of $475.56. Now, $475.56 compared to the price it's currently selling at gets us an implied return for the next 5 years of 2.17%, which is not very good. So yeah, Netflix has come down quite a lot. They're way cheaper than they've been for like 7 years, but they're still too expensive. They're still maybe 50% more expensive than they ought to be. For it to be a good purchase, obviously, because to become present value would be like 31% here, and obviously you want a margin of safety or something. So, long way to go for it to reach fair value, but it definitely has come down pretty significantly. The valuation score that we come up with for the company is 0.43, which it would probably be way worse than that if it wasn't for the fact that it is in fact a high quality business, as we determined by sales to capital ratio, returns on invested capital, and profit margins. But either way, because the absolute return values and the relative return values are just weak, so that's part of the reason it comes out pretty low. But it's holding its own relative to a lot of other companies with absolute expected return of 2% plus because of those qualitative factors. Now, the short-term pricing that we come up with for the company based off of multiples and the fundamentals that are traded against those fundamentals actually does give us an implied price of $503. So for what it's worth, based off of those types of short-term fundamental metrics, you could easily expect 17 to 18% upside, which would suggest perhaps more closer. It was trading closer to that short-term pricing level more recently. But again, I only use this as icing on the cake. I prefer to see this as a good value, and then this as a good timing signal. So the timing may look pretty good, but the long-term returns do not, is basically the point. So unfortunately, now is not the time for Netflix. Maybe the next time I evaluate. So one other thing I wanted to cover before I go today was something that was commented on the last stream. Was asking for more details about this value score that I've talked about so many times, which I figured I would try to discuss a little bit more in depth about how I use it for allocating things. I know I've kind of said that it involves a kind of a calculation of a bunch of factors, It's a little bit of an arbitrary numbering mix. I kind of have the little calculation thing going on over here, where the weights are on this row, which are again just kind of arbitrary weights that I've kind of like trial and error to find the weighting I like, and then some calculations to figure a bunch of things about return metrics, absolute and relative return metrics based off of the things I came up with here, and then the qualitative things where I'm comparing, I'm comparing the margins and the sales to capital ratio and returns on invested capital against what I would expect them to be in certain other ways. So it's a little bit of an arbitrary system that I came up with here to basically just like weigh in the things that I think are important for evaluation to come up with a score, which isn't as close to the thing that you asked about, but I figured I would explain a little bit more about that. So as you can see, like I said, I have the 0.43 here for Netflix, and I'll pull up an Intel, which is the other more recent evaluation we did, and I have like basically the same calculation going on over here to give me 0.91. It's like I said, it's just based off of a bunch of factors in the thing. Now, how that weighs into me making decisions, I'll sort of explain over here. It's a little complicated. I have all the companies that I've valued on the channel listed on each row right here, and I have all of their value scores listed right here. So I can relist the companies by value score and make sure that they're in order with each other, and then I have the S&P 500, which I've also scored in that kind of way, shifts up and down. So it's currently about 0.62. So I can see which companies are good values relative to others. And then in this row, what I do is I add up all the scores. I find out what the median is, the average is, the standard deviation, and various levels away by certain amounts of standard deviations of it, so I can get an idea of just how good a score is by comparing where it is, how many standard deviations up from the average it is, or something like that. So if a company is more than one standard deviation above the average score that I'm coming up with, then that makes it pretty good, and typically that's something kind of close to north of 1. It shifts around because, like I said, these numbers depend on what's in the set right now. But like right now, one standard deviation and up would be 1.06. So things over 1.06 are especially a good opportunity relative to other things that I've scored. Now I also do this score relative to things in my own portfolio. And for example, the average score in my portfolio is 0.96, the median being 0.99. And then one standard deviation up from that is 1.24. So if I was to compare really good scores against companies that are actually already in my portfolio, then I would want to maybe think about things that are higher than 1.24, which maybe would be a signal to buy into a company for the first time. See, like I'm willing to purchase more shares of something if it's just a good buy, but if I'm going to add something to the portfolio, it needs to be an especially good buy to make me select it and to diversify my portfolio further. So as you can see, there's only 3 companies that are scored higher than 1 standard deviation above my personal portfolio's average, which means that these 3 companies are especially interesting buys. 2 of them being home builders that we've valued recently, and another one being Biogen, a company that's already in my own portfolio. I have bought some Biogen recently, so that's easy to point out, and I've also pointed out that I started a position on KBH recently, so there you go. There's a good reason to point out why I did so. I also said that I purchased Valvoline recently, which is no longer above the 1 standard deviation point, but it was when I first bought into the position. So and now I'm still buying more Valvoline. I didn't buy into Hovnanian Enterprises, which is also a home builder above it, but if you remember, that company was highly levered, and so I was kind of waiting for it to be an especially good buy. Like I was going to wait for it to maybe hit the 2 standard deviation point if it ever did, and the 2 standard deviation point would have been north of like 1.5, which may never happen. Currently we're only at 1.41, but for example, only a week ago I think Biogen was scored at 1.5 something. The numbers shift around daily. The thing itself isn't the number. The thing itself is the number of any score in the set relative to all the other numbers in the set and the average of that set. That's the thing. That's the thing that matters, is that I'm using this score to weigh all of the companies that I have valued based off of metrics that matter to me and compare them to each other so that I can think about not just the absolute return, but also how high quality of a business it is when I'm deciding when to purchase something. And what this does is make it so that when a company is going down in price and becoming a better opportunity, that if two companies are dropping at the same rate in the market, the one with the higher quality metrics is going to be the one whose score is moving up faster. And so as a result, my attention is going to be drawn to the higher quality businesses over the lower quality businesses first. And the lower quality businesses have to rise up and score higher in order for me to take a pick at them. Now, I use other factors to try to determine what weight I think each company is going to be, and that also involves using the score. That's a little bit more of a complicated process, and I would kind of have to explain a lot of the stuff involved in the formulas, and I don't really want to get into that. But basically, if you wanted to do something like this yourself, you could do something similar. You just have to come up with a bunch of things that calculates the things that are important to you, give each of those important things a weight, weigh all those things together to come up with a score, and then weigh all of the scores together to come up with an average, and then compare any individual to the average. So, you know, it's just a kind of, like I said, it's arbitrary in a lot of ways because it all involves specific values that I have, and so it's all based on my personal values. It's not something that somebody should copycat wrote or anything, but you could easily implement a similar methodology. Like I said, the whole purpose of it was that I wanted to have higher quality businesses attracted to my attention over lower quality businesses, assuming they're dropping at the same rate. And again, but the definition of high quality or low quality is totally up to me. It's totally up to how I define it. You could come up with a million ways to measure that. And so as a result, like you see, I show you here, this is the list in order, but you can see that based off of absolute return, they're not in order. All right. I mean, you can see like right here, here's a 9% per year company that's outweighing many double-digit return expected companies, and we have double-digit expected returning companies that are way below many single-digit returning expected companies. And the same thing for just the total value upside or downside. You can see it's not in order. And the reason why is because of the qualitative factors that are listing certain things higher. So HP, which appears to be about fair value right now, has such high qualitative factors according to the way that I'm reading certain things, that it actually outweighs many companies that are undervalued on an absolute basis. Like, for example, ICICI Bank in India, which doesn't have very high qualitative factors. So the fact that it's very undervalued is not as important to me, because I don't necessarily want to hold a position in that company for several years. I want high quality businesses in my portfolio if I'm going to hold them for several years. And if I want to make an exception, then it has to be exceptional. So that's basically, I guess, the overview of that. I hope that that's satisfactory, and the person that asked for that ever does find that explanation. So as I said before, I'm not entirely sure what company we're going to do on Friday. I guess I'll have to see if Facebook or Amazon or Tesla has released their 10Ks. I know those companies have or are about to release their earnings, or there's several others in this week or whatever. You can see this is the earnings date that was expected most recently, and this is the date of the 10K that they released last year. So I'm kind of just using these two dates as a way to think about when to look at which companies, but this is sort of the vague priority list, but it depends on what companies 10K show up first. So we'll see what shows up by Friday, and if not, I have several other companies in mind for options to do, but either way, we'll do something. So if you enjoyed the stream, please subscribe to the channel, like the video, share with your friends, all that streamer content making stuff. We stream twice a week, Mondays and Fridays, usually around the time the market closes. Though with this earnings season, we are expecting to perhaps do a few Saturday streams, and perhaps this Saturday may be the first time we do that, depending on how many of these 10Ks release this week. For the short-term time frame, it might be 3 times a week, but in general, we are only promising 2 streams a week around the time the market closes on Mondays and Fridays. So if you enjoy in-depth financial analysis like this is the place to find it. I will catch you